Hello, this is practice problem 3-1A. You have a very similar problem to this in your homework, and I'm going to walk through the T accounts for this problem. I realized a few of you might be a little rusty on T accounts from financial accounting or may not have had a lot of experience with them. So I'm going to walk through this problem and kind of explain what's going on and what the purpose of T accounts are. So this is Sierra Company. It manufactures woven blankets and accounts for product costs using process costing. So this is our Chapter 3 process costing. This is for mass production. The company uses a single processing department. The following information is available regarding its May inventory. So we have 3 different types of inventory, very standard with any manufacturing company. Raw materials, as soon as materials are purchased, they go into raw materials. The next flow would be if those materials are used in the actual production of a product, they go into the work in process. And then once they're done, those materials, labor, and overheads that are used to produce something go into finished goods. And we have something that beginning inventory, and we have an ending inventory for each one of those accounts. The following additional information describes the company's production activities for May. So we know exactly how many raw materials were purchased on credit. Credit means to be paid later. We also know that there was some factory payroll cost paid in cash, a certain amount. Some other overhead costs, meaning these were actual overhead that was incurred. And then we have our materials, some used, some direct and some indirect. And then our labor used, direct and indirect also. Our POHR, or predetermined overhead rate, is a rate based on a percent of direct labor. So anytime there was a dollar of direct labor, as we learned in last chapter, anytime there was a dollar of direct labor, we are going to add $1.15 or 115% of overhead in addition to that labor. And then we also had some sales on credit, meaning the customers will pay later. Predetermined overhead rate was computed at the beginning of the year of 115% of direct labor cost. Okay, so I'm going to set up some T accounts for each one of these accounts for inventory. I'm also going to set up some T accounts for factory payroll. I'll set up one for our overhead account. And then we'll come back to those as far as what is an addition and what is a subtraction to each T account. So this problem wants us to solve for a few things. Based on the information it gave us, we're missing the amount, or I'm sorry, the cost of products transferred from production into finished goods, and we're also missing the cost of goods sold. So I'm actually going to look at each one of these accounts and kind of walk through what the T accounts tell us about the debits and credits. So I'm going to start off with my raw materials. Raw materials is an inventory account. So is work in process and finished goods. These are different types of inventory. They're all assets. They all increase with a debit. Remember, debit's on the left, credit's on the right. So anytime there's an addition to raw materials, I'm going to increase it with a debit, decrease it with a credit. Now the flow of materials always starts with materials, raw materials, goes into work in process, then finishes in finished goods. So anything that comes out of raw materials, anything that is used, will either go into our work in process or it's going to go into overhead. And anything that comes out of work in process inventory will be moved into finished goods. So raw materials, additions to raw materials. Well, raw materials always, or usually does, start with a beginning inventory. Beginning inventory balance. What's added to that are the purchases. And what comes out of that are materials that are actually used. So we start with beginning inventory, we add to that account any purchases, we take out of that account any materials that are used to get an ending balance. Remember, our balances are always showing up on the side, the normal side, the side that increases on. So our ending balance in raw materials will be a debit. Now those materials that were used, they're either going to go straight into work in process because they were direct, and I'm going to abbreviate a little bit, MTLS, materials, or they're going to go into our overhead account. Our overhead account has two different sides. There's an actual side and there's an applied side. Our actual side is where we're going to put the actual overhead. This is where we're going to find things that are indirect, like indirect materials used. All of our indirect costs go into factory overhead. That was one of those definitional things you heard about in Chapter 2. When we apply a POHR, the predetermined overhead rate, into our work in process, we'll see it hit on this credit side. But for right now, we're only going to talk about the indirect materials used. Materials used come out of raw materials with a credit and a debit to work in process for the direct materials, or a debit to factory overhead for the indirect materials. The other things that hit this work in process inventory account are going to be the direct labor, and overhead applied. I went a little out of order, so let's go back to this direct labor for a second. Anytime there is labor that's direct in work in process inventory, we're going to debit that. It's an addition. Indirect labor will be a debit to factory overhead. Notice how these are indirect and these are direct. The credit side for this example is going to be factory payroll payable, meaning it'll be paid later. I'm just going to throw it in here on the credit side, showing an increase. So it matches the indirect and the direct. The sum of these two labors, the direct and indirect, the debits will be found in those accounts. The offsetting credit will be found in the payroll payable account, meaning it will be paid later. The overhead that's applied into work in process inventory will be based on the 115% of direct labor that was given to us in the problem. So anytime that direct labor is applied in work in process, 115% additional for overhead is added in work in process. That's where this amount is found. Its offsetting credit is found on the applied side of factory overhead applied. So we have three things that go into work in process inventory. I should have also added there may be a beginning inventory in this account too. Start with beginning inventory. Add any direct materials that are used in production, add any direct labor used in production, and add the factory overhead that's applied. This gives us the sum of all of the costs that were added during work in process. These three things together are called manufacturing cost. I didn't plan my space very well, but I'm going to add it right here. So again, direct materials, direct labor, and overhead applied, those three things are called the manufacturing cost. And those three things go into what is being produced. When something is actually completed, it leaves the work in process inventory account, and we call it the manufactured cost. or the manufactured cost of goods. Notice it's past tense because it's done, it's manufactured. So we have costs added during manufacturing less the cost of the goods when they're done gives us the ending inventory. I draw a double line here too because that's how I show the balance in the work in process. On the positive side, our debit side, beginning inventory plus any direct materials used plus any direct labor plus any overhead that was applied less the cost of the goods that were finished, the cost of the manufactured goods. That gives us our ending inventory. Now those goods, this is the easy part, they go straight into the finished goods inventory. So whatever you take out of work in process, let me start with my beginning inventory first. If we have a balance to begin with, whatever we start with, we add to it the manufactured cost of goods. Or sometimes you might see it just manufactured cost or the cost of goods manufactured. You might see it a few different ways. But it's still past tense, meaning these goods are done, they're finished. So we start with the beginning inventory, and then we add to it the manufactured cost of goods, or the other way I said it would also be cost of goods manufactured. Let me put it that way too, so you can see the difference. So a little bit different, same thing, okay, so same thing, but we're going to add that in as a debit when we credit it out of the work in process inventory. Credit work in process when it's done, debit finished goods. The only thing that comes out of finished goods, as you might imagine, is when something's actually sold. The cost of goods sold. Beginning inventory amount plus the cost of the goods that were manufactured less the cost of goods when they're sold gives us the ending inventory amount. And again, I'm going to put the balance on the debit side because that's how we show an increase in this T account. Just a little refresher too, T accounts are just visual representations of accounts. When you're doing your journal entries, when you do your debits and credits, you would reflect those on the debit or credit side for each account. So basically you're just moving your journal entries into a T account for a visual of what's going on. Basically a ledger form, but in a little bit of a different format. So here we have finished goods. Start with the beginning inventory, add to it the cost of the goods manufactured, subtract from it the cost of goods sold, gives you ending inventory. Okay, let's go back down here to our factory payroll payable. I just summed up labor, but you've got to remember this labor includes both direct and indirect. So you want to have them listed out separately or combine them, whatever makes more sense to you. I believe Connect likes to see them separate. But this labor represents all of the labor that's incurred. So any labor that is incurred in the time period that will be paid later, aka payable, we'll have it as a credit. That's how a payable increases. And only when factory payroll is paid do we debit it, make it go down. So as labor is incurred, direct and indirect, we increase it with a credit. Only when it's paid do we decrease it with a debit. And just as a recap on our factory overhead, what's going on, any actual overhead, the indirect materials that are used, the indirect labor, or any other overhead cost, I'm going to abbreviate OH, any other actual, because this is the actual side, the debit side, all of those costs go on the debit side. The overhead that's applied, that 115%, that is going to be on our credit side. It's applied with a credit, and we put it as a debit into work in process inventory. Okay, so this is where it gets hard. So if you followed along so far on how these accounts, these T accounts are affected by each item, Then you can go back to your problem and start filling in the dollar amounts with what you know. For example, raw materials. Start with the beginning inventory. Raw materials, beginning inventory, 68,000. This is going to get a little messy because I'm running out of room, but I'm starting out with 68,000. I'm going to add to it any purchases. Raw materials purchases. Perfect. 260,000. Raw materials used. There we go. Raw materials used. 218,582,000. I can solve for my ending inventory, though it's already given to us. If you want to check your work, make sure you're doing this correctly. Take 68,000 plus 260,000, the positive side, minus 218,500 minus 82,000. You get $27,500, just like our balance tells us we should. Do the same with each account. Fill in what you know. For example, work in process inventory, beginning balance. Direct materials used, 218,500. Direct labor, 790,000. Overhead applied. Remember, the application of overhead means whatever direct labor was used, we multiply that by 115%, and that's the amount we enter. If we don't know a piece of information like what is the cost of manufactured goods or the manufactured cost of goods, then we could solve for it by filling in everything we know and solving for the missing piece. Add everything up that we know, less the ending inventory to solve for what left the account. That piece of information will be used as the positive in this account. If you're confused about the journal entries, I'd suggest you go back to your textbook. This is on page 94.